Okay, so it's February 16th, 2026. And if you've checked your portfolio this morning, let's be honest, it probably feels a bit like the morning after a really wild party. We hit that euphoria of $125,000 late last year, and now we're just chopping around this nauseating $50,000 to $70,000 range. The sentiment out there is just heavy.
It really is. But that's exactly why we pulled this specific stack of reports today, ARK Invest, VanEck, Wisdom Tree. Because there's a massive disconnect between how you might feel looking at the chart today and what the big institutional models are actually projecting.
And we aren't just talking about a simple rebound to the highs. We are talking about valuations that sound, frankly, a little ridiculous. ARK is modeling $2.9 million per coin. And strategy Michael Saylor's outfit is looking out to 2046 and printing a number of, $21 million.
Which on the surface sounds like total science fiction.
It does. So our mission for this deep dive is to figure out if there's actual math behind those numbers or if they're just inhaling their own supply.
Let's get into the math. The core argument in these reports isn't that Bitcoin becomes better tech necessarily. It's all about demonetization.
This was the concept that really stood out to me. It's the idea that Bitcoin acts like a sponge, right? Soaking up value from other asset classes.
Exactly. We all know the digital gold argument. That's the easy one.
Parity trade.
The parity trade, yeah. If Bitcoin simply matches gold's market cap, you get a price around, $750,000. But ARK and VanEck are arguing that gold is actually the small fish here. The real whale is real estate.
Because people don't just buy houses to live in them, they buy them to store wealth.
Right. It has a monetary premium. You pay extra because it acts like a savings account that keeps up with inflation. But look at this generational data we pulled. Gen Z is currently putting 20% of their wealth into crypto.
20%.
Versus only 13% in real estate.
So the theory is if you give people a better digital savings account, they just stop hoarding physical houses.
Precisely. And the math is wild. If Bitcoin captures just 5% of the global monetary premium currently sitting in real estate.
That alone gets it over $1 million.
That alone pushes the price over $1 million.
Okay, so that explains the long-term bullishness. But let's ground this in reality for a second. Right now, today, Standard Chartered is warning we could flush all the way down to $50,000.
They are. They point to sticky interest rates and ETF inflows sort of drying up. But, and this is the crucial nuance, they see this as a liquidity cycle, not a structural failure.
It's a washout.
They call it a washout, before a run back to $100,000.
Which brings us to the structural shift, because that washout might be happening to retail, but the sovereign debt supercycle is just warming up. This is the most surprising part of the research for me. We aren't just talking about BlackRock anymore. We are talking about nation states.
This is the game theory phase. VanEck predicts central banks will inevitably have to hold Bitcoin, just to diversify away from U.S. treasuries, and we're already seeing it.
Abu Dhabi.
The Abu Dhabi Investment Council just tripled their exposure to over $500 million. You have Ethiopia using stranded hydro energy to mine directly for the state.
And, of course, the U.S. The Bitcoin Act that's being debated in the Senate. The proposal to buy 1 million coins as a strategic reserve.
They're calling it the Louisiana Purchase of the 21st century. And just think about what that does to the psychology of the market, even if the act doesn't pass.
The conversation itself changes things.
Exactly. The fact that it's even being debated shifts the Overton window.
Meaning it moves the idea from radical and crazy to politically acceptable.
Right. It turns Bitcoin from a speculative tech stock into a geopolitical imperative. Because if the U.S. might buy it, can China or the EU really afford to have zero?
And corporations are front-running this too.
Yeah.
We've seen this digital asset treasury model from Strategy and Japan's MetaPlanet.
Oh, yeah. They issue stock to buy Bitcoin. The Bitcoin goes up. Their stock goes up, so they issue more stock.
It's a feedback loop.
It is. But it changes the market mechanics. We used to obsess over the halving cycle. Every 4 years, miners sell less. Analysts are saying that model is dead. We are in a flow cycle now.
So it's less about the miner supply and more about institutional demand.
Right. When sovereigns and corporations buy, they don't day trade. They lock it away for decades. That liquidity shock is much more violent than a halving.
So let's wrap this up for you. The price is down, the mood is terrible, but the underlying infrastructure, the nations, the banks, the corporations, is expanding.
I'd summarize it like this. The data suggests this is the weakest bear case in history.
Weakest bear case in history.
Yeah. The price is dropping, but the adoption is going vertical. The spring is coiling.
It reminds me of that final note from Van Eck regarding risk.
Oh, that was a heavy thought, wasn't it? They suggest we've crossed a mathematical threshold where the risk of having zero exposure to Bitcoin now technically exceeds the risk of owning it.
Because if it does go to 2 million, being left behind is more dangerous than the volatility along the way. That is an uncomfortable thought to leave you with. Thanks for diving in.